Welcome to the portfolio review for the Total Return Bond Fund. My name is Andrew Su. I am a co-portfolio manager for the fund, and today I'll cover the performance and positioning through April 30th of 2026. I did title this webcast "All Eyes on the Horizon," really as a metaphor for a sailor trying to navigate through rough seas. Um, in challenging sailing conditions, it is important to keep your eyes on the horizon, not only to steer clear of hazards, but also equally important to find opportunities to seek shelter if you do need it. There are plenty of macro challenges out there currently that we are watching out for. Markets have remained a lot more calm than expected given this backdrop. So let's talk about the portfolio positioning and how we are navigating through this. So first slide here, we'll start out by looking at the different share classes of the total return bond fund. Here we see the various share classes and also the minimum investment sizes, and then also the gross expense ratios for each of these share classes. Shifting gears and just looking at performance, we have seen some volatility in fixed income markets so far this year. Much of it has really been rate driven. Mortgages, they did have a strong January. News of the GSEs, and I'm referring to Fannie Mae and Freddie Mac here, embarking on a $200 billion buying program, caused spreads to tighten very quickly in the mortgage space, but then almost just as quickly reverse course once the Middle East conflict began. Within the credit space, lower rated leveraged loans saw some spread widening, especially within the software related areas. And we could see this on this chart, triple C bank loans, the worst performer year to date. The total return bond fund, it doesn't invest in corporates or bank loans for any credit exposure. We actually use the dark gray shaded area. That is securitized credit. It has fared very well on a relative basis, and we have seen spread compression during the year, and also with lower duration, less impact from rates. Next slide here, looking at returns now. I'll just focus on the year-to-date column. The iShares, which is DBLTX, has had a positive 19 basis point return through April 30th of this year. And it has outperformed the index by 12 basis points. A little bit more granular view of performance. Once again, just focusing on the year-to-date column here. Contribution to return has really been driven by the credit exposure within the portfolio. CLOs, non-agency or non-government guaranteed mortgages, and asset backs all performing very well year to date. We have seen strong investor interest in these areas, and then because of lower duration or less interest rate exposure, that has helped them avoid some of the headwinds from rising rates experienced during the first part of this year. Here, we're looking at composition of the total return fund. For listeners who might be unfamiliar with the fund's architecture, the blue shaded area represents government guaranteed investments. And this is going to include everything from treasuries to the agency CMBS, which are commercial mortgage-backed securities, CMOs, and then pass-throughs, which are both mortgage-backed securities. The other shaded regions, so the other colors, are the credit portions, and this is going to include CLOs, asset-backed securities, non-government guaranteed mortgages, and non-government guaranteed commercial real estate investments. The government guaranteed assets, I'll point out, do account for over 50% of the overall portfolio at the present time. Some portfolio statistics here on the fund. I just want to draw your attention to average market price, slightly higher for the fund than the index, but you'll have to remember that a significant portion of our portfolio is government guaranteed, and those assets will naturally accrete towards par over time. If we look at duration next, essentially in line with that of the index. And then finally, we do have, looking at the yield to maturity, a 66 basis point yield advantage despite the very high quality assets in our portfolio. Fund duration, just a visual depiction here of fund duration over time. The fund duration is represented in the gray line, and we're comparing to both the index duration, which is the blue line or the dark blue line on the top, and then the 10-year treasury yield in yellow. We have had meaningfully lower duration versus the index in the past, but currently with rate volatility and then some potential for government intervention in the future, we are comfortable with our duration positioning here. In terms of positioning of the overall fund, we have had some modest changes in the portfolio over the course of the last year. So here we're comparing April of 2025 to April of 2026. So if we start at the top left portion of this table, we have seen some reduced exposure within the agency MBS segment. And largely, this was taking gains in January post the news of GSE buying. And then we shifted some capital and added incrementally to the credit exposure, really kind of evenly across all the segments of credit. And you can see that in the right portion of the table. Um, Outside of the shift to credit, there has also been repositioning inside the government guaranteed kind of mortgages area. And we have increased our focus with higher coupon the higher coupon portion of the mortgage market. You can see that in the middle table. We reduced low coupon, less than 5% coupons by approximately 8%, increased greater than 5% coupon mortgages by 8%. And then a meaningful decrease in floater exposure to move into fixed rate product. I would say overall portfolio quality has improved with all of these moves. Cross section look at one of our biggest segments in the portfolio, the agency MBS segment, and this is what it looks like as of April 30th. Pass-throughs account for 23% of the portfolio. CMOs and government guaranteed CMBS also a large component. And then finally, the other segment. This is going to include treasuries, tips, and then agency debentures as well. We do get most of our duration from this portion of the overall portfolio. And then with mortgage-backed securities agencies and agency CMBS, we do get the added benefit of getting spread on those assets that are less correlated than traditional credit products. So not only getting some duration, but some uncorrelated spread with inclusion of those assets as well. Closer look at just the pass-throughs. Pass-throughs are found within the index, but we are definitely not index managers and will tactically allocate within this sector to generate alpha. So here we're comparing our allocation in pass-throughs across different coupons to the index. The blue bars will represent the fund's weightings in these different coupon stacks. And then we're comparing to the index in gray. We are underweight both lower and middle coupons part of the stack and overweight the higher coupon of the stack, higher coupon stack of mortgages. Now, diversification, it does help us outperform in different market environments, and investors should expect that this allocation shifts as the opportunity set and the landscape changes within the macro markets. We spoke about duration in general for the fund. This slide here is really looking at key rate duration, or how the fund duration is distributed across different parts of the term structure. We do have a steepener on in the total return bond fund, and you could see that here. We do have a heavier weight at the 2-year part of the curve. Again, fund positioning in blue, index in gray, so larger exposure to the 2-year part of the curve. And then if we look at the long end of the curve, you can see that we are significantly underweight versus where the index is in terms of the 30-year part of the curve. Looking here, we're looking at this credit segment of the portfolio. A lot of numbers. I won't speak about all of them. I just highlight some of the areas that we're seeing developments. Non-agency mortgage-backed securities. This is composed of both legacy assets, and legacy means pre-Great Financial Crisis type assets, and then also new issue. So new issue non-government guaranteed mortgages has largely been in the non-qualified mortgage space. So anything that doesn't qualify for an agency type loan would fall into this kind of category. And then also NPL, RPL type exposures, which stands for non-performing loans and then reperforming loans within the mortgage space. In the CMBS space or commercial mortgage space, very well diversified. We always get the question though about office exposure, and I will highlight it here with my cursor. Only about 1.84% exposure to office in the overall portfolio. So relatively small. We do look at these opportunities. We do find opportunities that are very attractive here, but very small in the scheme of things versus the overall portfolio. And then within the ABSAs, we are focused more heavily on commercial ABS. These are hard asset secured. So you actually have a hard asset securing it versus consumer products. And the decision to overweight hard assets versus consumer is very much deliberate and is really driven by the stage of the economy we are in. And then lastly, CLOs at the very bottom right here, we are focused at the senior most part of these structures. So very defensive exposure in the CLO space. Here, we're just looking at index data. And the point on this is really, if you look at the overall fixed income space, absolute spread levels are still very attractive in structured finance. And this is the green portion. And if you compare it versus other areas that are various other colors, you will see that structured finance assets on a spread basis are very attractive. Now, again, pointing out these are index related, and DoubleLine always focuses on doing better than the index here. Um, you'll see that still from a percentile ranking perspective as well. The lower the percentile means the closer it is to all-time tights in each of these spaces. You do see that the entry point for many of these assets still very attractive versus where they historically been as well. Resiliency is very important to us, and here we're just looking at a cross section of our credit exposure within the fund. And what we're doing of this exercise is looking at serious delinquencies, and that's in red, versus the amount of credit enhancement, which is the protection to absorb losses, in blue. And you can see that regardless of the subsectors within the credit space, we have a lot more protection than serious delinquencies. And you need defaults really to move up significantly to see any risk of impairment. So we do see our positions as very well positioned against any type of market volatility. And then from a spread perspective, very attractive as well. So not only do you have security, you also have attractive spreads here in these spaces as well. We continue to see mortgages as a very attractive sector, and they not only carry at an attractive rate, spreads you see at 111, and that is wider than investment grade corporates, but they also have attractive optionality, meaning spreads can tighten the space. Now, there are some catalysts that can drive spreads tighter. One would be reduced rate volatility. On the fundamental side, if that were to occur, you have typically seen spreads compress as rate volatility subsides. The other is really around the technical side. We are seeing large buyers from the banking side stepping back in and buying mortgages, and that is accretive from supply and demand technicals, and that can further drive in spreads. So attractive carry on the mortgage side, but then also the ability to generate some additional total return from spread compression here, both from the fundamental side and the technical side. In terms of the curve, the steeper position helped us pretty significantly in 2025, but so far in 2026, it has been less helpful. I mean, you can see the curve essentially flattening in the beginning part of the year. We continue to believe that deficit funding will cause the yield curve to steepen over the longer term, so we continue to maintain our steepener within the portfolio. In terms of inflation, we have implemented tips into the portfolio. It's just 1% approximately right now, so it's still very small. But here we see break evens and real yields charted next to each other. Inflation is top of mind for us, as it is for the broader market. But I will point out that with real yields rising, and you can see this on the right more recently, markets are indicating that we may see tighter financial conditions. If we do indeed see tighter financial conditions, the total return bond fund is very well situated for this. We do have very liquid, high quality assets in the portfolio. And then on the credit side, we are senior in credit with lower overall interest rate risk. So if there is rate volatility and tighter financial conditions, we are very well positioned for this type of scenario. Labor market, key indicator for markets. And I'd really say Fed policy is really kind of laser focused on this at this point in time. What we're looking at here is data from the Bureau of Labor Statistics. And this data does show you some volatility if you're looking at the bars. The tan bars essentially showing non-farm private payrolls over a 1 month change. But it really kind of focusing on the blue line here is the 3-month moving average. And you can see that there's not a whole lot going on in the labor space, meaning growth is very, very minimal. And this is causing some issues. It's translating to lower wages, and that is impacting consumers at the household level. And it's a good segue into this slide here. Consumer delinquencies still far from GFC type delinquency levels, but we are seeing a steady rise in delinquencies across most consumer sectors. Credit cards, autos, they continue to put pressure on the household. But what's more interesting to me is really, despite the strong housing market and then the really strong borrower base in the housing market this time, the gray line at the very bottom there, it is starting to migrate upwards. So that is interesting. It is indicating that households are under some type of pressure. Again, very far away from GFC type level delinquencies within the mortgage space. But just the fact that it's rising is indicating that households are under some pressure. Looking at commercial real estate now, here we could see that what we're looking at is the RCA CPPI index, and this is a transaction-based property level index showing valuations. We have been bullish in the CMBS space, and those positions have been contributing positively to our performance in the fund. But you can see that there has been improvement in terms of valuations on commercial real estate assets. Retail channel, this is the yellow here I'm pointing to, they are running into some difficulties with consumers being impacted by higher inflation, falling wages. That is, logical to see that. But we are seeing generally improvement in terms of valuations on the commercial real estate space. This is helping CMBS transactions in terms of spreads and performance as well. Last slide here, just on the macro side, we are invested in AAA and AA CLOs, so very top of the capital structure, and those structures have a lot of protection to them from a structural standpoint. Here we see bank loan defaults, and they're hovering right around 2%, which seems relatively benign from a historical perspective. But given some of the pressures that we're seeing in the software sector in the bank loan space, we are keeping a very close eye on this. Where we are invested in the portfolio, defaults, even at GFC type levels, would not cause principal impairment to our positions. But we are mindful that rising defaults would increase spread volatility. So again, watching this area quite carefully. Final slide here, just a summary of both month end and quarterly returns to the fund. A lot going on in the macro space. We're keenly monitoring all of these variables and then reposition the portfolio with the aim of providing the best risk-adjusted returns to our investors. I do thank everyone for their interest in the vehicle. And if you do have questions, please reach out to our client representatives, and we'd be happy to answer any questions. Thank you very much.